Okay. Okay. Hello. Good evening and a warm welcome on behalf of HDFC Mutual Fund. Uh, my name is Sresh Sahani and I look after the Eastern Zone for the firm. I also have my senior colleague Orgo Dattagupta, the regional business head, along with me on the call. It is indeed a great pleasure to connect with all of you along with our entire team and would like to thank each one of you for joining this call today. I sincerely believe that all of you and your family members are safe and fine. Request you to please take utmost care of yourself. Friends, currently we are going through unprecedented times across the globe. Change is the new constant. So whether it is elections in US or whether it is elections in Bihar, the wave of change is visible everywhere. So coming back to our point, we don't know how long it may take to normalize the situation. But please remember, history has proven that opportunities always lie in tough times. As legendary investor Warren Buffett has shared, be fearful when others are greedy and be greedy when others are fearful. Also, history shows that investments done during the tough times have yielded better results over time. Having said that, for today's webinar, we have Gopal Agarwal, our senior equity fund manager with us today to share his views on equity markets and our funds. As you would be aware, Gopal has joined us recently and has more than 16 years of experience in fund management and equity research. Before joining HDFC AMC, he has worked with DSP Investment Managers, Tata Asset Management, and Mirai Asset Management. Gopal manages HDFC Growth Opportunities Fund, HDFC Focus 30 Fund, and also co-manages HDFC Equity Savings Fund. With that quick introduction, I would now like to hand over the call to Gopal Agarwal. Gopalji, over to you.
Yeah, thank you. Good afternoon, everyone, and welcome to this call. So, Shrest has already given the brief, so I'll take you through the thoughts on the market and the economy. And I will be definitely open for whatever questions you may have. Please be free and candid to ask whatever questions you may have. So, first of all, uh, as I always speak on my call, that market is generally defined by the four important fundamental drivers, which is earning growth, liquidity, and interest rate. So today we are in a scenario where liquidity and interest rates are very favorable for the market. As you know that oil prices are behaving in a very subdued zone of around $40, and we are running now a current account deficit of only 8.5 to $9 billion per month, which is substantially below the $15 billion per month, which was the run rate earlier. So we are amassing huge forex reserve because of FDI inflow of over $36 billion in the last 6 7 months. So in our forex reserves have gone up to $560 billion. Our liquidity in the banking system left window is over 3 lakh crores. So we are seeing that reverse repo has become the operating rate. So suppose a company wants to take 3 months, 6 months, or 9 months loan through commercial paper, all the rates are below 4%. So which is a very positive scenario for market. Deposit rates have come down to between 5.1 to 5.5% for 1 year deposit rate. And so, and 10-year GSEC is trading at around 5.89%. So we have seen the very good scenario for liquidity and interest rate. And my sense is that as energy prices are likely to remain benign, we will continue to remain in a comfortable zone. Though variables may change, but definitely we are in a comfortable zone. Now coming to the earnings part, after many quarters, I can tell you that the Q2 is the first quarter where we are seeing a very good earning growth actually. So in this quarterly results so far which has come, I would say they have beaten the street estimate in most of the cases, and these are really positive. The major factors for positive surprise in this current quarterly results are First is that in most of the cases we have inventory gain, because you know that by end of March, April, the crude oil prices went to negative and it was hovering below $20. So whatever has been purchased during that period, is now being used. So you are seeing the inventory gain. Similarly, steel prices are up by around 5,000 rupees per ton. Aluminum prices or is everything is up, and even in chemical prices in most of the cases. So we are seeing inventory gain across the board. Second case is that in most of the cases, the companies have reduced the marketing effort, promotional expenses, travels. So all this cost saving is actually giving the benefit of 2 to 3% fillip to the operating margin. So a combination of inventory gain or benefit of the lower raw material cost. Second is the benefit on lower promotional expenses, advertisements, and travel. So we are seeing on an average 3 to 4% expansion in operating margin, which is percolating to the bottom line of the company. So this quarterly result season is very, very positive. And now some of the recent indicators which have come now, economy has come back to around 94 to 96% of the pre-COVID level based on the data which has come in the month of October, and as is stated by ICICI Bank in their recent quarterly update. So the economy is back to 94 to 96% of the normal pre-COVID level. And this quarter, this month, in the month of October, we have seen a very strong GST collection of 1,05,000 crores. If this kind of run rate sustain, then the feared level of the GDP decline of 10%, which is predicted by IMF, as per the various experts, that our GDP growth decline may come down to 6% if this kind of GST growth, GST collection sustain. So definitely we are on a improving path. We are on a recovery path, which is really positive, which is being played out in the marketplace. Second point is that based on the earning estimate of Q2, which is positive, if this kind of trend continues, then most of the brokers and all have their estimate. Our EPS of the market can be between 666 to 670. Okay. So based on that, at 11,900, we are trading at around 17 and a half times P multiple. Okay. Of the based on the FY22 earnings. And if you look at definitely that our 10-year GSEC has now come down to 5.9%. You know that risk-free rate is 10-year GSEC, and 10-year average of 10-year GSEC is 7.35%, which is now trading at 5.9%. So definitely there is a case of P multiple expansion of the market with lower interest rates, because stock price is nothing but as a future discounted cash flow to the present value. As the discounting rate is going down, so the price has to go up. So this is the driving factor of the market. So in this scenario, I would say that I would not say that the market is cheap, but I can tell you that market is reasonably valued. And if this broad-based recovery which we are seeing in economy in terms of power generation growth, the traffic growth, the e-wage bill generation growth, and GST collection, if it continues, I think there can be a reasonable upside to the market with volatility, because the interest rate is in our favor and we are now seeing the recovery, earning recovery is in place. As I said in my opening remark, market is driven by earnings, earning growth, liquidity, and interest rate. So if there is a earning growth, then definitely the market will remain strong. That is the moot point, but always there can be volatility. Okay, so we should use this volatility to make our investment decision, because earning growth and liquidity both are favoring the market. Now, coming to the sectors and fund, I will give you some brief on every sector's outlook, which you may be interested to know. Okay, so I'll start with the banking and financial sector. So COVID-related stress has resulted into 3 to 4% slippages or the stress formation in the system based on the various results which has come, and the as the guidance given by the most of the banks actually, right? So So even SBI has reported today they are talking about 60,000 crores of total stress formation in FY21, which is likely to be sub 3%, around 2.5 to 3% of their loan book. And in general, all the large banks reports between 2 to 3.2% PP pre-provisioning operating profit to the loan book. So even in the bad case scenario, the banks are they are generating good profit, so that they are not likely to report a loss. Okay, so it means even in a bad scenario, we'll have a book value addition. And uh, and most of the banks which have raised capital from the equity market, that the banks have cumulatively raised 84,000 crores from the market, and they are very well capitalized. Their CET1 ratio for the large private sector banks are hovering between 16 to 18%. So I would say that this is a very positive scenario. And so their capital is intact and their book value is rising. So I would say that any fall in the banking sector stock because of XY any reason can be used as a buying opportunity. So the banks, I am not very much worried. Only thing which is really alarming for me is that in the banks, credit growth is not very strong. Credit growth in the banking system is only 5.7%, and YTD figure till end of September was actually negative. So I was, I am little worried on that part, because the margin expansion has a limit. But if until unless the top line growth continues, you can't make always profit, बिकॉज सेविंग करने की तो एक लिमिट होती है, कमाना जरूरी होता है, तो क्रेडिट ऑफटेक होगा तभी कमाई होती है, राइट? तो ये एक ही कंसर्न है मेरे को बैंक में, बाकी मुझे कोई मेजर कंसर्न नहीं दिखता है ऑन देयर प्रॉफिटेबिलिटी, बुक वैल्यू एंड देयर कैपिटल एडिक्वेसी रेशियो पे, right? Now I come to the second large sector, which is, let me take as the oil and gas sector, because Reliance is also a part of it. So in this sector, I am really not positive on refining sector because of demand destruction in oil, because of COVID related case. Even in CY21, International Energy Agency is estimating that oil demand will be lower by 2 million barrels per day as compared to CY19. In CY20, oil demand is down by close to 8.4 million barrels per day as compared to CY19. And even in CY21, they are expecting over 2 million barrels per day demand destruction. So what I can share, that during this period, a lot of new refineries have seen the light of the day in China, and even in India, some of the refinery expansion have come in place. So we will have more refining capacity than demand. So definitely in this scenario, the refining margin is likely to remain under control. Similarly, even in petchem side, we are seeing in China 9 million tons of new capacity has been created. So it may lead to some pressure on polymer prices, polymer margins, especially in the times to come. So though I am not very positive in this sector, only I am positive on the marketing side, because of the refineries have been upgraded to BS6 fuel. So in BS6 fuel, they can charge better margin, and also working capital requirement is low. यदि आप $100 का माल बेचते हैं, तो आपको यदि एक महीने का रिसीवेबल है तो आपकी कॉस्ट ज़्यादा है। यदि आप $40 का माल बेच रहे हैं, तो डेफिनेटली आपकी वर्किंग कैपिटल रिक्वायरमेंट कम हो जाती है। और साथ साथ जैसे मैंने कहा कि अभी जो सीपी रेट है, कमर्शियल पेपर का रेट है 3-6 मंथ्स का, वो सब 4% है। तो आपको एक इंटरेस्ट में भी सेविंग है, और से क्वांटिटी ऑफ अमाउंट ऑफ कैपिटल रिक्वायर्ड हैज आल्सो कम डाउन। So marketing is a bright spot for the refining and marketing business. On the gas side, I can share with you that on the gas business, we may see a strong energy, gas price, because many countries are now following ESG, and they are really try to abandon the coal consumption and shift to the gas. And if this kind of transmission, which is continuing in the developed world particularly, so what has happened? The coal prices have come down, and gas price, which fell to sub $3, is now hovering around $6 per million BTU. which is the LNG price. So prices have almost doubled in the last 2 months. And my sense is that if this kind of transmission from coal to gas continue, so the prices can remain strong. So which will have an additional impact, but net oil marketing company can do better. That is the view on the net oil and gas sector. Now, coming to third large sector, which is the IT sector. In IT sector, what I can share with you that in the last 1.5 years, the IT sector has done well because of few reasons. One is that we had a rupee depreciation from 69 to 75 rupees to a dollar. Second point was that that in COVID related case, what has happened, the work from home and reduction in travel and visa costs has given them around 3% operating margin boost. Okay. And add to this a near term digitization and cloud shifting by a lot of corporates has also given them the business, right? Though I would say these are the low margin business because digitization is a low margin business, but rupee depreciation and the combination of lower travel and visa costs has given them adequate margin, and that is why we are seeing this sector has done well. Now going forward from 75 rupees to a dollar, definitely rupee is unlikely to see a material depreciation. Okay, and second point is that now I would say that the IT companies are doing great, but definitely from here onward, if they have to perform, we have to see how banking and financial sector and other sectors does also, because what has happened very clearly that in banking sector particularly, in USA as a 10-year GSEC has fallen to 60 bips or 70 bips. Today it is at 80 bips. So this is not a healthy scenario of profit for banking and financial industry in the USA. Subject to who wins in USA and what is their policy, it will decide the 10-year GSEC. And so based on that, we'll take a call. Net, I would say that IT is a good sector because they pay you almost 70 to 100% of their profit as a payout, right? So definitely you get a dividend yield of 4% plus, and you have a single digit top line, and the sometimes you get the benefit of margin levers, so you get around 10-12% bottom line growth. But it is not secular, it will have a volatility, so we have to be take a call based on the variables which plans out. So I can say that at this valuation I'm kind of neutral on the sector, but I will really visit the variables before taking a final call on the sector. Now coming to the another sector, which is telecom sector. Net in telecom sector, because of competition, heightened competition by the largest player, we are seeing that the price recovery is delayed but not denied. So that is why this sector is recovering, but at a slower rate. Even the shifting from 2G to 4G can lead to ARPU addition, and which will be very positive for incumbent, which is strong in balance sheet. So I'm positive on the sector because eventual shifting from all the 2G players to 4G will certainly happen. Even in India in today, 49 to 50% users are 2G user. So gradually they are shifting from 2G to 4G, and this will lead to higher ARPU for the player companies. So this is a slow recovery sector, but definitely outlook is good actually. Right now, I come to the another sector, which is this cement business. In cement, the good part is that now um, you had the benefit of lower input prices in terms of coal prices and transportation cost, and the individual housing construction is really rising. One data point which we I have witnessed over years, whenever your home loan rate is below the PPF rate, no, so people shift to buy or construct their own house. And also which is led to a recovery in the housing sector. So cement, I am positive. Though I am positive more on Southern India player, Western India going forward, and northern part of the country. They are better placed in this scenario. Now, I talk to the another sector, which is materials and mining sector. In metals and mining sector, we are seeing the steel market is quite healthy today. Uh, in this, India is well positioned because we are surplus. We have self-sufficient in iron ore, and we need to import coking coal. So coking coal prices are down, and iron ore prices are up. So which is the biggest benefit for Indian steel industry, and that is why our Indian steel industry is doing good. On other non-ferrous metal, I am most bullish is on copper, but we don't have direct play on copper in our India. So generally, rule of thumb is that the copper and aluminum prices goes in ratio of 3:1. So if the aluminum copper prices goes up, so aluminum will also go up, because for the lower uses, people shift from copper to aluminum at lower prices of aluminum. Okay, so that is there. So I'm quite constructive on the ferrous and non-ferrous sector. Now coming to the other sector, which is automobile. In automobile, I'm more constructive on auto ancillary and four-wheeler players. They are likely to do well because of when demand for in terms of social distancing, there may be demand for personal vehicle actually. So which is likely to do well. Then on coming to pharmaceutical sector and chemical sector, these sector are very secular growth sector, but in the near term, we have seen a benefit of all in the 1 or 2 quarters, which may not sustain. So I am positive on the sector, but I will be very selective going forward because my view is that easy money has been made in this sector. So now we need to work hard to get good stocks because in the last couple of months, what has happened, as I explained to you, you had the benefit of lower promotional expenses, lower travel cost and all, and even the lower raw material cost benefit, and people were stocking because of fear of COVID. So you had all the things which has been played out. So which is likely to normalize by third quarter or fourth quarter. So we have to see how things shape up after that. So I'll be very selective on that. Now, the sector which is left is now consumer staple and durable. I'm positive on both the sectors, but definitely COVID will have some impact on the savings and earning power of individual. But India is such a heterogeneous country where like 20 crore people which are in pink of health, they will continue to spend. So we will have to watch where we have to put money in this sector, but so I will be selective buying in my portfolio. So these are like some of these thoughts on this. Now I just run through the fund which I manage is a focus fund, equity fund, and a growth opportunity fund. In currently, I am running a portfolio which is having higher exposure to utilities, engineering, construction, oil and gas sectors. What I can tell you, I'm not changing them materially because of the last 18 months of earnings slowdown related to GDP growth decline in India and combined with COVID and the government finances turned into stress, we saw the problem in this sector. And now, as the sector has become very cheap, I would really wait for normalization in earnings and valuation, and then I will certainly try to diversify the portfolio. I can tell you that my portfolio currently is underweight on let's say IT, pharma, chemical, consumer staple, and discretionary. So I will make it much more broad-based portfolio going forward. But I will do it once I will see the normalization of earning. And but one thing I can assure you that going forward, the in the next couple of years, our portfolio would be more broad-based, so that the will try to reduce the volatility in portfolio. So this is from my side. Now I open the floor for any questions.
Yeah. So thanks, Gopalji, for the update. It was truly insightful. We have already received few questions from our partners, and I would request if we can take them. First one, Gopalji, again. So two general questions pertaining to COVID and the US election, but you may take it together. So the first one is ki due to COVID-19, there is significant impact on corporate profits for FY21. We were earlier under lockdown, then it was unlocked, and now globally we are again seeing lockdown in most of the countries. So, what impact do you see on earnings of the firms, and will it impact their ability to grow in near future? This is one. Second, which I am clubbing along with it, is a general question again. Given the US elections, what is your view on the markets? That do investors need to consider anything given US is the largest globally? So these were the two, and then we can take it forward.
Sure. So first of all, on the earnings side, you know that the Q1 was really washed out quarter because of you had a lockdown, and so that is why the pent up demand and everything came into Q2. So we really saw a big recovery. I can tell you, even if the run rate of Q2 continue, we may end up with around only 7 to 8% earning decline as compared to FY21, FY20. So it won't be that big downtick in earning in FY21. And I can assure you that market is not at all looking at FY21. We are only looking at run rate of recovery. We are now actually focusing on FY22 based on extrapolating the results of FY20 Q2, and also the way opening up is happening in economy. What is more important for investor at this juncture now is the opening up of economy in India, and also the data point in terms of credit growth, in terms of vehicle sales, power generation sales, vehicular movement, e-way bill generation. These are the data point which we are monitoring very closely. Okay, and what we are seeing month on month, we are seeing the improvement in most of the variables, or you can say almost all the variables. So which is very important. Okay, so the currently I can tell you market is always forward looking, not the backward looking. So there is no point in looking at FY21 earning. We are now moving towards FY22 and FY23. Generally speaking, by after by the end of the calendar year, market start looking at the projection of FY23. So if there is no hiccup again, and if the opening up of the economy continues in India, and there is no people are actually watching how COVID scenario will play out after the festive season. Because what we have seen, let's say in Europe, they had opened up in summer. In summer month, people do party in Europe, you know that, right? And after that, you are seeing the surge in cases. Like in India, Onam also in Kerala, we opened up, and then we saw the flare of cases, right? So what market would like to see the after the Diwali festival and all, how, and then we will have winter season sets in. So how COVID plays out in December and January, and if by February we are under control, definitely things will look better. But people will assess the COVID impact by February, January, February, right? So that is one important data point which you all investors can keep in mind, rather than anything else. Because the way demand has come back in Q2, it is very heartening. Even if you look at the sales of automobile in the month of October, though it is a wholesale sales number, not the retail sales number, but in some of the cases it is lifetime high, right? So this is a really very heartening number actually. So we have to see how things shape up continuously, but we are in a right direction. That's what I can say. And GST number also tells you that story. Now coming to US election and all, see in US election, what is important to understand is that like India, they have also the which we say Rajya Sabha and Lok Sabha. They have also Senate and House. Okay, so what is very important, you need a president and the same party rules the Senate. If this combination comes in, no, then the situation is in your favor. So suppose so that you can take the bill pass. very easily. Suppose president come from a party and senate comes from different party, then you will have a problem. You got my point. So what we are watching in this result, which is underway, is that who controls senate and who is the president. And I can share with you what market is more worried or more curious is that how the new stimulus measure come, because what happened, whatever money has been given, the impact of this will be completed by the December, and after that we will have a sharp slowdown in USA if the further stimulus doesn't come up, right? So what market is very much worried and anxiously watching this election is that who will come and what kind of stimulus will come, right? Broadly speaking, for equity market perspective, uh, we are not much impacted by the both the parties. Only thing is that the Democrats does physical infrastructure and Republicans believe in tax cut. Okay, so tax cut boosts the consumption, while Democrats leads to infrastructure construction. That is the thing. Which, if they do infrastructure investment, then what happens? The banks does well, and 10-year GSEC hardens, right? So which leads to EM flows. So that will be more positive, right? So that is the situation. But what I can share with you, Trump is also equally positive for the market because US is running 18% fiscal deficit. So the dollar is under pressure. So we have to only see who wins and who controls the Senate. If we get the both from a same party, that will be the best outcome we will have for a Indian market perspective. Right. Yeah.
Fine, Gopalji. Thanks for that update. Another on the same lines, general question on the market is liquidity seems to be driving the markets currently. When do we expect to see the reversal in terms of markets moving back towards long-term fundamentals?
No, see, I can tell you, first of all, initial rally always happens by liquidity, but thankfully, the results and fundamentals are improving. So I would say that now we are slowly heading towards the fundamentals. Okay. So I would say that fundamentals are improving. So I'm not very much worried on the market.
Okay. The next question, Gopalji, is on the index. Index has been outperforming open-ended funds, and it is becoming difficult to beat the benchmarks. Also, there is a lot of debate on passive versus active strategy. What are your views on the same?
So, as I said in my remark very clearly, if you have to beat the benchmark, what happened? You need not to take very concentrated bet on few sectors because I always jokingly say that India is a country which disappoint both optimists and pessimists. तो यदि आप बहुत ऑप्टिमिस्ट हो जाते हो तो कुछ भी वेरिएबल्स आ जाते हैं वो नेगेटिव कर देते हैं, और यदि आप पेसिमिस्ट हो जाते हैं तो कुछ वेरिएबल्स आके बहुत पॉजिटिव कर जाते हैं। तो इसलिए अपने पोर्टफोलियो को है वेल डाइवर्सिफाई रखना बहुत ज़रूरी है। यदि आप देखेंगे कि मार्च 2015 से फरवरी 2020 तक फार्मा ने वन वे अंडर परफॉर्म किया, राइट? जैसे कि फार्मा का वेट जो इंडेक्स में 7% था 2015 में, वो गिर के 1.8% बॉटम में आ गया, 5 साल अंडर परफॉर्म किया। पर आप देखिए नेक्स्ट 6 महीने में क्या हुआ, फार्मा इंडेक्स ही डबल हो गया। यदि यदि आपने ये किसी भी चीज को राइट ऑफ मत कीजिए, दिस इज द बिगेस्ट लर्निंग वी हैव इन द मार्केट। तो इसलिए मैंने कहा कि यदि हम पोर्टफोलियो को डाइवर्सिफाई रखते हैं तो ये होगा कि ये बेनिफिट इसका ये है कि आप अंडर परफॉर्म नहीं करोगे, राइट? तो अभी जैसे आईटी है, अभी ये रुपया 69 का 75 हो गया, राइट, इन 20 बिकॉज ऑफ अवर जीएसटी कलेक्शन वाज वीक, अवर ग्रोथ वाज स्लोइंग डाउन, you know that the rupee got weak, right? So that IT did well. So these are like variables which are not in your control. So what a fund manager can do or must do is to diversify the portfolio, and I will try to do that so that we should not underperform, and definitely stock picking will work.
Sure, Gopalji. Another question, Gopalji, is on the NPS in financial sector. So, given the moratorium, what are your views on the increasing NPA side?
So what has happened? We have met most of the companies, and they have come out with results also. And what we are seeing that total stress in the banking system, in the good private sector bank, and some of the large banks are not in excess of 3 to 4% of their loan book. As I explained to you, that the banks are well capitalized because they have raised 84,000 crores from the equity market, and they have picked up to loan book of 3% pre-provisioning operating profit every year. So I can tell you this time the banks are good profitability and better capitalized to weather any kind of storm. So I'm not overly worried on this. And as the credit, only worry I have is on credit offtake rather than credit quality at this juncture.
Sure, sir. The next one is there any real possibility of tapering too happening in near future? What are your views on it?
No, it is not possible. It means I have a very strong conviction because what happened, US is running 18% fiscal deficit, and Q2 growth, Q3 growth, which they have reported in GDP, is mainly due to this package given to the consumer of $600 per week. And because of this stimulus package, the US demand has come back and the growth came. So, as I said in my remark, what we are watching in this election is that who comes and what kind of stimulus comes, because the effect of this is, money which was given will fade away by end of December. So I would say that tapering currently, I will rule it out actually.
Sure, sir. Another one is uh, what is your view on gold in near future? So it is not a specific
Yeah, I can share with you that I don't have very specific view on gold. Uh, you know in general, it is a very general comment I can only part that whenever the expansion in Fed balance sheet happens, it is generally advisable to keep some investment in gold, but I don't have real knowledge about gold actually.
sure. Uh, so, Gopalji, while you had given elaborate feedback on each sector, but specifically somebody has asked your view on the pharma sector. Given that pharma, we have seen a recent rally in pharma, what is the outlook going forward?
So pharma as a sector is a very secular sector, and the companies are very strong. So only thing I would say that you had a great earning growth in the last 2 quarters because of, I can tell you that the MR was not going to the doctors, so the promotional expenses, marketing expenses, travel expenses, all were down, and a combination of this with inventory gain or lower input prices which were there in chemical, because you know that the all the pharmaceutical input are primarily oil derivatives. So you got the benefit of all in the last 2 quarters. So after third quarter, many things will normalize. Okay, so I am positive on the sector, but I'll be selective.
Sure. Uh, so, Gopalji, that was basically on the markets. So now coming specific questions pertaining to your funds. So first one is uh, what would be different in your approach in managing both the funds, the growth opportunities and the Focus 30 from the earlier strategies that we had?
See, I will not comment on what was the strategy adopted earlier, but I will really comment that what I will do, because I'll be very specific and very direct. One thing is for sure, my approach, as I said in my opening remark, market is driven by earnings growth factor. So I will try to find the drivers for earning growth, and I will try to invest in those companies in my portfolio. Second approach will be, certainly I'll be more diversified in portfolio, because I will try to capture the majority of sectors of the market in the portfolio, so that we will see the less volatility in the years to come. And I can assure you, I'm totally bottom up, As you can understand from my many interpretation of macro and micro, I combine both the factors and try to look at the earnings driver. So earning growth is the most important parameter for investment. So which is my style. So I will try to find out the growth companies in my portfolio.
Sure, Gopalji. Gopalji, within that, very curious to know more so from a investor perspective, any specific style that you would adopt, the growth style of investing, the value style of investing, or it would be a combination or a mix of both. So what would be the style that you would be adopting?
See, what I intend to do is that blend of growth and value, but I'll try to be more growth oriented. Then some portion will be certainly value oriented, but majority will be growth oriented because in India, what happened, we are a growth economy, and so we have to have a earning growth. See, I tell you, this growth value, public sector, non-public sector, these are very simple nomenclature which I don't follow. What is really important, I tell you, for investing is a simple thing. You need earning growth. You need, if you sell something, you should have a receivable easily. Money has to be collected, right? So if you are improving working capital cycle, if you have earning growth, I can tell you, you tick almost all the boxes. Then third point is that the reinvestment of profit. See, in most of the cases, what happened, Srest, the companies which have destroyed wealth for the investor are those who have really diversified. Suppose you were doing in construction, then you went into real estate, you went into power plant, you went into this and that. So what happened? You lose the focus. Okay. So what, suppose you were doing X, you started buying cricket company, you were in football, or what happened? This is what the shareholder require. We are shareholder, right? We are not promoter. We require ROE. ROE, higher ROE when it comes when you redeploy the profit well, or you pay back the profit to the shareholders, right? In terms of dividend or buyback. So what is very important for us as a unit holder is the ROE. So, I would really tell you that working capital cycle is most important parameter for investor and also earning growth. So I'll try to work upon that.
Sure. Gopalji, a related question to it. The question is, ki, since you took over, there is no significant, or there is no sizable change that
Yeah,
is visible in the portfolio. So somebody
correct.
has asked, ki, what is the timelines that you are seeing in terms of changing the portfolio as per your philosophy, so when it can be visible?
Yeah, so I can tell you that this is work in progress because what happened as soon as I took over, then definitely what happened, these stocks were under pressure because of the liquidity and receivable issues and all. So I am expecting as the growth is coming back in the economy, government finances are improving with improved GST collection. I hope in the next couple of months things will start looking better. So I'll try to get my stock at a right price and definitely I'll make a change. I can only assure you that I'll make significant changes in the portfolio over a period of time and I'll make it more diversified. So I'm also as keen as my investor to improve my performance.
Sure. Another question, Gopalji, is this is pertaining to the PSU stocks in particular. So, what are your views on PSU stocks, given that it is reflecting in both the portfolio's growth opportunities and Focus 30? So, your views on it.
See, very clearly what I have said, I don't differentiate between PSU and non-PSU. What is important is the growth driver. Okay, growth driver, receivables, working capital, So what I can tell you that in the last 2 years when the economy started slowing down, even before COVID, that our GDP was contracting or slowing down from the highs of 7.5% to 4.2% in the just preceding quarter to the COVID. So what happened? Our economy was slowing down, and also you have a fiscal constraint in India. So combination of these two led to, these sectors, these companies in the core sector of economy started underperforming. My sense is that whatever is the scenario, FY21 would see the worst of everything in terms GDP contraction, in terms of government fiscal, right? So going forward, things will certainly improve, and as the things will improve, I will really assure you that I'll try to make it much more diversified.
Sure. Thanks, Gopalji. Gopalji, another question is more specific, and this is on the performance of the funds. So the question is, ki, when can the investors see improvement in terms of fund performance?
See, this is a journey, and I can assure you, it is for my career also. I have to improve the performance, right? So, uh, I will not give a very specific timeline, but I can only assure you that we'll do everything possible to better our performance from where we are today. Really, I know that this is the most important thing, and I will be taking judicious action.
Sure. Again, Gopalji, related question. Uh, what should uh, uh, what should we do now for existing investors who are there in the fund since last 3 to 5 years, where returns have not matched to their expectations, but we are still holding money in the funds? What's your advice to those investors?
See, I can tell you, Shrestha, as you have seen, last 2 years were very, not very strong in terms of growth and earnings. So this core sector of the economy has impacted more on this. So as we are likely to pass the worst of the growth slowdown and everything, so things will really start looking better from where we are today. So people should have much some more patience to get the benefit of of their investment. So I would really urge them, to have some more patience, because we are passing through the worst, and we have all. I think the most of the data points shows that we have already passed the worst actually.
Sure. Gopalji, next question is pertaining to the polarization of returns. So somebody has asked, what should the investors do? So whether it should be, and this is again a general question, whether it should be direct investing in the current environment, whether it should be international investing, the global investing, or whether one should look at domestic investing via mutual fund route. So what are your views on that particular subject?
See, in international investing, what I have observed actually, only the tech related sector, Nasdaq has done well, or S&P 500 has done well in the last 15-20 years, because it was a secular run. And barring that, I would say there is no difference between Indian investing and international investing. So the tech sector has really given significantly higher return. So those who had invested in US Nasdaq and all, or S&P 500, which has also the higher weightage of tech related stock, has done well. Otherwise, if you look at Asian equities or European equities, or I can tell you the India has done equally and good actually, right? It's not inferior to any other market. So in international investing, only the tech side one can even look at if they want to. I mean, that is what I can share. But see, I'm not very much expert on US market, but as I used to track it very closely, what I can share with you that in US the tech sector is also getting benefited from lower interest rate. You know that in US now interest rate is 0.7% or 0.8% 10-year GSEC is trading. So the companies which can give you better dividend than zero point 0.8 and which can grow are trading at significantly higher multiple, right? So if the interest rate starts hiking, in US, so situation can be, very different. And now at 3400 S&P 500 or Nasdaq where it is, the valuations are are not very comforting, I would say. It is good, it's still they can offer you reasonable return, but only, as I said, US in tech investing has only helped as compared to if you would have invested in Dow Jones or another market, it is more or less the same return what you got in India. Okay. So now in terms of direct investing or mutual fund investing, I can only share with you, that the market is polarized. Whether if you were lucky and you had all the information and knowledge, so definitely you can do direct investing. But if you don't have any time and knowledge, you can come through mutual fund, right? And you know that the our cost is also not very high, right?
True.
And I can tell you this, people when talk about narrow market, broad market, I can tell you very stressed, very clearly, the market is slave of earning growth. See what has happened. 16, 17, it was a broad market rally. You saw mid cap did well, small cap did well, even index did well on a broad basis. But what has changed after 2017? After demonetization and GST implementation and after ILFS crisis in India, you saw a real slowdown in our economy, right? Definitely. Then what has happened? And then you had the US-China trade war related issue, right? China has also gone through the slowdown. World economy was slowing. So you saw that the core sector got impacted very badly, right? And in this scenario, what has happened? The consumer lending was very good. You got the 7 pay commission benefit which came in 2017. So you got some of the automobile sector or some of the consumer lending company or consumer related companies did so well, right? And so that was a flavor and that did very well. So that is the main reason. See, I can tell you the market is slave of earnings. Wherever earnings come, so money is always there, so they do well. So now what I can tell you, my sense is that as we had already seen this year -6% or -11%, whatever GDP growth will come this year, but certainly we are down. So if you are down, you will bounce back. So the next year will definitely be a year of growth. So what I can share with you, you had the pain. So invest, remain invested for some more time, so we can have much more broad-based rally. So see, if you look at today, when your interest rate is sub 5%, right? 10-year GSEC is at 5.9%, CP rates are below 4%, you are getting money. So what I would really tell you, this is the ideal time for remain invested in the market actually.
Sure. Sure, Gopalji. Gopalji, two questions, related questions on the funds, and I will take it together. So the first question is the portfolio
See,
turnovers in,
Shrestha,
yeah,
on the same line, I would really like to share with you one thought.
yeah,
Uh, you know, Going forward, no, people should have reasonable return expectation from the market also, because
sure,
when we show the chart from 2000 or 1990, so the base was so low, so the returns were very high. But what I can share with you now, our economy is already reaching to 2.7 or 2.8 trillion dollar, whatever it is. So, we will also grow at sub 6% on a sustainable basis, looking at whatever data point which is there. You got my point. So the people should have the expectation of return accordingly. Means they will not be disappointed. Means I'm
sure,
I'm very open to share with you, because the higher base also lead to slower growth. So even if
sure,
you look at other markets, this is a simple story, except the tech investing.
sure, sure. Sure. Sir, two questions pertaining to the funds. The first one is the portfolio turnovers in both the schemes are pretty low as of now. So is it buy and hold strategy, or will we see this moving up going forward? That is one. Second is the top 10 holdings in both the funds are pretty similar. So will it change, or any change? Your thoughts on that, both the questions.
Sure. So definitely I do less of churning historically. Since 2005, I'm managing money, and my turnover ratio is between 40 to 70%. Okay. it is never crossed 70, and it was hovering around 40 to 50% only. Right, that is my track record. So hope means I will be within that. You can assume so. And then in terms of holding changes and all, certainly I will do more changes in the portfolio. As I please understand, some of the stocks got beaten very badly. So I want, and I feel these businesses are very solid and they're trading at a attractive valuation. So I want to normalize the valuation.
Sure, sir. Sir, the next question again is on a sector. So, what is your view on rich valuations in few of the FMCG companies?
See, very clearly till the time you show the margin expansion, the receivables are under control and top line growth. So we have no authority to comment on valuation. So if this kind of top line, margins, working capital, these three things are very very important for investing. And if all the three boxes are ticked, so they will continue. Any company will track at a higher multiple. And if at higher valuation, your responsibility becomes much more to show higher growth. Otherwise, you can't sustain the higher multiple. So far, what has happened, these companies are able to show growth because of lower benign commodity prices and also premiumization. So I would say that till the time earnings are continue, they may trade at where they are, and if the earnings disappoint, they will correct.
Sure, sir. Uh, I think we have covered up all. So, just checking last time. Is there anything missed? So, sir, last question is on the fund categorization. Given that it is both the schemes are equity-oriented schemes, uh, uh, one is the growth opportunities is large to mid, and Focus 30 is large, mid, and small multi-cap strategy. So, is there any advice to the investors that going forward, no doubt both are diversified equity fund, should one look towards any market cap bias that one should be going only into large cap or should be going only into mid or into small, or what is your view what one should be seeing going forward?
Okay, I can share with you my thought process. Okay, because what I will do, I can only say on my thoughts. So,
Sure.
what I feel, a reasonable size company leads to higher wealth creation rather than a very
Yeah.
tiny company. Okay, it means what I have observed over years is the companies have a operating profit of over 200 crores, right? They become very meaningful in size or reasonable in size, and at least they can weather any kind of storm of interest rate volatility or currency volatility or demand slowdown. So, what I like, a company should have reasonable operating profit so that they can withstand all kind of challenges in economy, and they create more value. So I believe in buying a reasonable size company rather than a very tiny company in the portfolio.
Sure. Thanks, Gopalji. So, Gopalji, again, one related question I have asked you, but there is again one related, and if you would like to address that. So, one of the long-standing distributor who knows you earlier also. So the question is, ki, earlier you never used to, or you used to not own PSU stocks in particular in your portfolios, but this time it is there. So is it related to do with the stock picking, or it has to do with the fund house philosophy, or any change on that? Your views on that particular point?
See, I can only share with you that I never demarcate between PSU and private because
Sure,
business is business actually.
sure,
So I will keep it to that, and we will do all the changes possible to create wealth for our investor. Okay,
Sure.
so uh, oh, for me, earning growth and working capital, these are the two most important variables, and I will stick to it.
Sure. Thanks, Gopalji. So those were all the questions that had come to our table. So thanks for your time, Gopalji, and thanks to all our distribution partners who are there on the call, present on the call, for your time and patient listening. We are sure this call would have added great value and will help you in sharing views with your clients. So thank you once again, friends. Be safe, be healthy, and most important, please take care of yourself. Thanks, Gopalji.
Thank you. Thanks. Bye.
Yeah, yeah.